April brings a new tax year and a raft of tax changes. One of these will have a big impact in Cumbria, affecting contractors who operate through personal service companies to limit their tax bill. Here, Chamber Chief Executive Rob Johnston discusses what's happening with business journalist Julian Whittle, who joined the Chamber earlier this year as Business Engagement Manager.
OK, Rob, so what's meant by a personal service company?
Well, for example, instead of being an employee of, let's say, Sellafield, obviously the biggest operator in this space, you set up a company and bill Sellafield for your services. So you become a company as opposed to an individual. And by taking a modest wage plus dividends from the company, you can save on income tax and national insurance contributions.
Fair enough. So what's the problem?
Well, HM Revenue and Customs have got wise to this, as they're simply scanning everywhere for closing down everything they say is a loophole. And they've been clamping down on the abuse of what they call the IR35 rule. And it's what they call disguised employment, which is when they decide someone is technically not a contractor, but is doing the job of an employee. So it's effectively, they're saying you're an employee by any other name. Now, they can impose penalties of up to 100% of the tax due, and that can go back for 4 years for tax and 6 years for national insurance contributions. And we've heard to date of a number of people with very significant bills coming out of this, some of them approaching six figures.
So what's changed with the start of the new tax year?
Well, there's a significant change that affects contractors working for examples, say Sellafield, but other public sector organisations, the NHS. Previously, the onus was on the contractor to declare themselves from the onset. They were in rule IR35, and that avoided the tax, them being taxed as an employee. Under the new regime, responsibility passes to the public sector organisation that's paying them, and the public sector organisation will be liable to pay any tax, including back tax, if HMRC decides later that the contractor is really an employee.
Well, that sounds better on the face of it, because the public sector will end up carrying the risk instead of the contractor, won't they?
Yeah, they will, but that's where the law of unintended consequences has kicked in. Terrified that they'll be hit by a huge tax bill, the public sector organisations have said to the contractors, right, we're going to treat you all as employees and start deducting tax and national insurance, which is not a good thing because not everybody is operating as the government are accusing them, should we say.
That's not what the government intended, presumably.
No, and at the last minute, the government inserted a reasonable care clause into the legislation, which means public sector organisations must look at each contractor individually and see if they fall foul of the rule. So they can't take a blanket approach and treat them all the same way. But it's still going to be a big hit for many contractors.
Yes, now I've heard that some are so fed up they may walk away from public sector work and opt to work in the private sector instead.
Well, and if they do it's probably only going to be a temporary respite, to be fair, because we expect really this to be rolled into the private sector. I mean, what we're seeing, Julian, I think, is the public sector putting its house in order before it gets heavy on the private sector. So it's entirely feasible this will roll through. And it's interesting to note that the government was forced to backtrack on plans in the budget to raise national insurance contributions for the self-employed. But they're still targeting what they see as abuse of self-employment. Now, there's various views on that abuse of self-employment. I think some of us would argue that these were put in as not as benefits, but as a counterbalance to the lack of security of employment in others. And it's actually fueled a lot of the growth of our economy. The fact that people can move around quite quickly as contractors from both sides. You can hire, but you can also leave and move your intellectual offer, say as an IT project manager, around. So this isn't a healthy thing, we don't think, in that it restricts the ability for people to move around and benefit from that. But also, I think to be fair, it does help counterbalance the lack of security for employment.
And there's a review going on, isn't there, that's expected to report this summer, which may lead to stricter rules as to what counts as genuine self-employment.
Yes, and we welcome some clarity around that definition, because we don't want to see unnecessary restrictions that limit employers' flexibility in contract options, for example. So it's about getting the balance right, and it really is important we get the balance right and we stop treating those who are self-employed as if somehow they're evil tax avoiders. They're operating within an agreed framework.
There are other big changes coming in this month, aren't there?
That's correct. What is the apprenticeship levy? Now, this is in effect a new tax to fund apprenticeships. Businesses with a payroll of more than 3 million a year will pay a levy of 0.5% on their wage bill above this threshold, even if they don't have any apprentices. Now, smaller businesses won't pay the levy, but they will have to pay more. Previously, employers didn't pay for the training their apprentices received. Training delivered by further education colleges or specialists such as Gen 2, for example. But going forward, employers will pick up 10% of those training costs.
Right, and the national minimum wage, that's gone up too, hasn't it?
Yes, or the national living wage as the government likes to call it, for over 25s. The hourly minimum went up from £7.20 to £7.50 on the 1st of April. There were equivalent increases for younger workers and first-year apprentices, and they must be paid at least £3.50 an hour, up from £3.40.